For paper 2, the file is out there.
Are you recording too?
Yeah.
Okay.
So if you go out to the file, paper 2 company data in Excel. So I don't want to spend a lot of time on this because I have a video that does everything, but I gave you 10 companies or so. I can't remember how many. 13 companies. And they're alphabetical and they're also lined up, so you can just click on them. So all the data you need it's there. So I've done all the work for you. What you have to do is write up about it. But the video I did for, if you go out to the YouTube channel for our class, the very, very last video, it's only about 30 minutes, but it replaces last Tuesday. You don't have to give me nothing because I know you're going to watch it because it's on the paper. It walks through how I got this data, which I think is really, really useful because you can see how Bloomberg brings this data in really, really efficiently. And I actually recommend you get a Bloomberg account and write paper 2 sitting at the Bloomberg machine. So you get some practice using Bloomberg, you can talk about it. So there's a lot more data than what I showed you. I just brought in the last 5 quarters just because that's what you're going to write about. But there's a lot more data there. I even did the basis points calculation for you. So what I was looking for were companies whose stock price moved quite a bit. Some of them, like who was it? It was up 16%. Netflix, yeah, I mean, just crazy, crazy numbers a day when the market was down. So there are some pretty crazy ones. Some are only up 2 or 3%, but they're really large companies like a Nike. So 2% was a pretty big move for them. So you should have everything you need. If you go into Bloomberg, you can find articles. You got Bloomberg Intelligence. You have plenty of stuff that you can draw from for a lot of really, really powerful quotes in your paper. So a lot of good resources. So if you don't like these 13 companies, you could pick another one as long as they'd released earnings September, October, but you'd have to do all the work to get the data because I'm not going to do it again. But it's, it took me like 10 minutes per company. So that's 2 hours worth of data. So it's not easy, but it explains all the numbers, reported comp estimate. And then down at the bottom, you have charts that show you how the stock actually performed on that day. So Abbott was up 3% when other like Pfizer and Bristol Myers were down significantly. So it tells you something is going on. All right, so watch the video, write the paper. You don't have as much time as in the first one, but you still have more time you do in real life. So instead of 30 minutes, I'm giving you 2 weeks or a week and a half, but it's a very straightforward paper to do. If you're really concerned about grade and all that kind of stuff, then you probably should be in the FSC with me, your draft paper with me the day before it's due, to make sure some students lose really simple points, like forgetting to talk about last quarter, last year, or something like that. I mean, that's a big chunk of points that is so easy to do, so you don't lose the easy points, especially. But all right, any questions on paper 2?
Did JB Hunt go into bankruptcy?
I don't remember hearing them going to bankruptcy. If they did, it hasn't showed it yet. There are more logistics than shipping now. Logistics has been doing really well, but I don't know specifically on them. All right. So on Thursday, we'll do the return calculation, the holding period return, and the link view, just like it's going to be on the second exam. So you can both prepare for the exam and be the hero for your team by preparing for it. So you might as well, work it out, practice, get some good exercise. All right, let's finish up beta. So yeah, this is not the right file. I don't know what happened to my file, but anyway, so we'll jump down. I fixed it just earlier, but I don't know why I guess I went to the wrong spot. I'm in the wrong spot. There we go. All right, so we said last time beta is a forecast. I'm going to say, what kind of firm do I have? Is it cyclical or defensive? Now, what company you do for papers 3 and 4, you don't have to do what you did for paper 2, but you might. A lot of those companies for paper 2 would work for paper 3 and 4. So you'd have some background and make it a little easier to write it. So is Abbott Labs a defensive or a cyclical company? I probably think, lab is probably more defensive. Healthcare people are probably going to get their lab work done no matter what the economy is doing. Tesla obviously is a cyclical company. So, you have what you need there. Once you do that, then you have to ask about operating leverage and financial leverage. And I give you that file to help you with that. Operating leverage is fixed costs. And it's somewhat a question just how volatile is their net margin? If it's more volatile, that implies a higher beta. And then financial leverage, pretty straightforward. Look at their debt to equity and just ask, do they have more debt than the typical company or less debt than the typical company? So the last thing I want to do is history. And I think we did it last class. So I don't see it. So I'm going to do it again, just give you some practice, but you also have videos out there that you can do. To get beta, what you have to do is get your stock price versus the market. Get your stock price. You can get that off of Yahoo Finance. I don't know what stock I want to do. Well, I just mentioned Abbott Labs, so let's see if I'm right that it is defensive. So I'm going to put Abbott Labs in there. So you go to historical data, and we're going to be using monthly. Yahoo Finance used to do weekly, but now they do monthly, so we'll do monthly. I do like monthly better. You can go back as far in history as you can. So monthly, we can go back to 1980, apply, and then download that. And eventually it will go somewhere. Didn't do anything. I don't see it. There it is. So now we have their data back to 1985. So when you download it, it doesn't go back as far as they say. We're going to use the adjusted close. Remember that adjusts for stock splits, although I think both of them, all of them adjust for stock splits, but mainly for dividends. The main reason, the difference in these two, so stock, you can see they've had stock splits because there's no way Abbott Labs stock was trading for $1.32 back then. But there's a big difference between the close and the adjusted close, and that's all doing with dividends. All right, so we don't want some of them paying a dividend to distort their beta, so we're going to just use the closing. And then we need the market, and here's where my video is probably wrong. So you actually want to use the XPX. Don't use this one here. That's the G something. I forget what they call it, but the SPX is what you want. For some reason, the one that's right here, they no longer give you historical data. So we'll max on that. I'll probably still go back to 1985. It says it goes to 27, but they don't actually give you that. And then you apply and download. Yeah, it goes back to 85. For some reason, you just stop it there. It doesn't matter to S&P if you use the close or just a close because it's a price index. There's no dividends. I know S&P stocks pay dividends, but the way this is set up, it doesn't really matter. So I can delete that. I'm going to copy them both in. I mean, the years in, I don't really need the years, but I'm going to copy them in. I just want to make sure I'm starting in the right month and I'm ending in the right month. Now, this is October. October hasn't ended yet, so I'm going to take October out. And I don't need this anymore. So now I have Abbott, I have the SPX. And then what I have to do is the holding period. So the holding period is just like we said, ending minus beginning. There's no income because that's already in the formula. So that gives us our returns. That first month was pretty good back in 85. Second month was really good for Abbott Labs. You're seeing some pretty massive numbers in here, 86. Both down this last month. Abbott had a really, really tough August. So what we're going to do is a rolling beta. What you did in your 3013 class, unless you had me, was probably this type of chart. And then your beta was the slope. I don't do that. Did y'all do that in one of some of your classes? I remember doing that. So that's the way most professors do beta. I don't like that approach because it's just a glob of numbers. So I'm going to take that out. I don't like it. Instead, what we're going to do is a rolling beta. We're going to do 60 months. So to do 60 months, we need 60 months. So I'm going to find month 60 is probably on line 64 or so. So there it is. So I'm going to do my beta. So equals slope. Slope is the formula for beta. And you have to do your company first and then the market, 0.98. So that's their beta for 5 years ending January 1990s. That's the number Yahoo Finance is showing. So there's two things I'm not 100% sure on Yahoo Finance, if they're using adjusted close or close, and if their 5 year includes October. So there could be a slight difference. We'll see. It should be pretty close. The next thing I want to do is look at some ranges. So I'm going to use the equal percentile function. And I want to take the percentile of that at the 50th percentile. So that gives me the median. I want to do it to 10% and at the 90th percentile. So the 50th percentile, the median is 0.71. That sounds consistent with what I said. It was defensive stocks. 0.71 would be pretty defensive. That's kind of a Walmart, or maybe not Walmart, but a little higher than Walmart, but not a cyclical company at all. So I'm going to bring that down. And I'm going to graph it. You look at your last number. The last 5 years number was 0.68. That's a number you can compare to Yahoo Finance. Oh, that's the S&P. Let me go back to ABT. How close was it? Y'all see that? I got 0.68. Sometimes it's off by just a little bit, but again, maybe the adjusted close and the dividends don't usually have a huge impact unless they have a massive dividend. So it usually isn't a big deal. But it's possible October's in there and that could have some noise to it. But 0.68. So that gives you some confidence you did it correctly if that last number is correct. But that's the only number Yahoo is showing you. The last 5 years could have been pretty unusual. So I'm now going to graph that. Give it a title. Got to give it dates. But I don't need months, so I'm going to format that. I'm just going to use year. The other thing is I don't like a lot of white space in there, so I'm gonna format this just to go to 160. I don't know why Bill Gates wants to go to 180, so I'll put it there. So there they are. The median's 0.7. You can see they've been much lower than that, especially during the 2008 through 2009 crisis. They went very low. That seems way too low. They've been as high as over 1, so they've been as high as 1.1. That seems way too high. They had a really high period back here. What do you think might cause that? Why would Abbott Labs suddenly become highly correlated to the market in 2020? COVID, probably, right? That's probably a COVID impact. So that's somewhat settled back down. But why do I use the rolling? Because if you're using Yahoo Finance and you're sitting right there, what kind of valuation you can get for your company? Does that sound like the right beta to use for your company? Way too high, right? So if you use that, you're going to get a valuation of EBIT that's like, 12 cents when the stock's trading for whatever, 30, 40 bucks. So that's all Yahoo Finance is giving you is that one number. The number today looks pretty reasonable, 0.68. That's just because we're right at a pretty reasonable period of time. Now, if we do the entire period, which is what that graph I showed you before does, you can get a very, very different number than the median. It's possible. So there it's a bit lower. The other thing I noticed, I should have done Walmart. If I was showing you Walmart, one thing with Walmart, what you notice is their beta a long time ago was really high and it comes down over time. And that's pretty typical. When Walmart was a small company, betas tend to be higher when you're a smaller company. So when I look at that, I actually say, you know what? That's two companies. I'm going to delete those first 10 years because that's not reasonable. That's not Walmart. And I'm going to get rid of them. I'm going to do my chart starting in whatever, 1995 or something. So if you see a distinction, first 10 years is one thing and the last 10, last 20 is something else. You might just delete, don't even start in 85, maybe start in 95 because it's just so different. So look at the chart and see what it's telling you. Because if you use those high early years, your median is going to be much higher, and that may not really reflect what the company is doing. So you'll put this in paper 3. It took me I'm talking a lot. It takes like 5-10 minutes to do. It's a pretty easy thing to do, pretty powerful. So why do I do it like this? So I had one of my portfolio managers speak to my class, and he says, I hate beta, and this was his argument for why he hates beta. The theory of beta is your beta should be pretty constant over time. Because if it's systematic risk, your systematic risk, it's not like Abbott used to sell cars. Like in 2020, they started selling cars, and then they decided to go back in healthcare. And then in 2008, they started selling gold. No, Abbott was the same company all along. What happened? The systematic risk changed. So it was COVID was the risk, so they became highly correlated. In 2008, it was a financial crisis. They're not a financial company, so their beta dropped dramatically. So it's not that their systematic risk changed, it's the systematic risk driving markets changed, and so their exposure changed. So I like this chart because it helps you justify your numbers. So their last beta, 0.68, is a pretty reasonable number. On paper 3, you'll pick a beta. In my security analysis class, they have to run scenarios. What's my low? What's my high beta? And you can do actually, and I might show you how to do a data table. So you can look at different scenarios for growth and beta to see what the valuation might be. Because, a firm like this, maybe the beta is 0.8, maybe it's 0.6, somewhere in between. You'll get pretty different valuations depending on which one you use. All right, so you'll have another video that does this. The difference between this one and the video that you're going to see that I use in the video for the paper 3 and 4 is that I didn't use the SPX, I used the GSPC or whatever the other one is. So you have that advantage that you don't have to copy and paste it in. Questions on beta? Pretty wild how volatile that is. The theory completely defeats the theory for that to be so volatile. That's why I say beta is a number you forecast. It's not a number you look up. Because if I pick my beta here off Value Finance, I would have Abbott Labs worth thousands of dollars. If I picked it here, they're worth like $1.50. It makes a big difference. But what is Abbott Lab? It should be a 0.7, 0.8 beta. It just makes sense. It's logical. The history somewhat supports that, but it's volatile, and it's volatile for most companies. In fact, I don't know what it's doing. In fact, Walmart's beta has been negative in some periods of time. A negative beta is theoretically a really, really strange thing. You're not going to use a negative beta on paper 3. I can assure you, you'll get some really wild answers. All right, let me see if I can save this. All right, everybody's good on beta. So how many classes have you had beta in? The second class? I bet you have beta in almost every finance class you take. Now, if you take John Tui's class on fixed income, you probably won't hear beta at all unless you get off into a side tangent. But I bet in Katapakham's class, which I highly recommend, corporate finance, I bet he talks beta. So beta keeps coming up a lot more in colleges than it does in real life when you get out there. Beta is somewhat lip service. I remember one firm I was talking to, it's like, what discount rate do you use for stocks? They said, we just use 10% for every stock. So that's crazy. You're telling me every stock is, you're telling me Tesla is the same risk as Walmart? That seemed crazy. So they just threw out all the theory altogether. Seems crazy. I use beta when I value companies, but not everybody does. Everybody has maybe a different process. There are other theories out there. The arbitrage pricing theory, that's a little more complex. It's more of kind of regression analysis, looking at multiple factors. So CAPM beta is a one-factor model, which is why it's a little bit hard to use because that one factor is a little more volatile than it should be. But I like beta. I like the concept of beta. You're going to plug beta in paper 3 into your discount rate. We'll get into that in more detail. So CAPM, y'all should know that without even thinking. You should be dreaming CAPM, risk-free rate plus beta times the market risk premium. It's the most famous formula in finance, written by William Sharpe, Nobel Prize. He won a Nobel Prize for that. He wrote it in the early 60s. He's still around doing stuff, doing impressive stuff, but that's his baby. Even if you don't believe in beta, you have to admit that theory has radically changed finance. It's changed the way we think about certain things, even to hope. Remember passive investing? A lot of the passive investing came off of this whole concept of systematic versus unsystematic risk from beta. So he had a huge impact. So he deserved to get the Nobel Prize because he had a huge impact, even if you don't like this particular approach. All right, so we're going to shift gears. We're going to talk about security valuation. You probably did this in 3013 as well, so we'll do it again. So Brandon and Beverly and those in my class, you have to see this again, but that's okay. Get some practice. So we're going to do a valuation of a security. You could also value real estate and other things using the same theory, but we're going to do securities, stocks and bonds. The value of a security is just the present value of the future cash flows. Real simple. So all we need to know is what's the forecast of cash flows and what's the appropriate discount rate to use. The discount rate is going to be risk-free rate plus a risk premium. That's pretty standard. The risk-free rate is usually what kind of security? A what? Government. Yeah, treasury securities. So we'll use treasuries as well. Our treasuries risk-free. Congress is trying their hardest to convince us they're not. I don't know what's going to happen in November when we don't have a Speaker of the House. That's going to be pretty crazy. It was interesting. S&P downgraded the treasuries from AAA to AA. Treasury prices went up because they created so much confusion and uncertainty. People bought treasuries as protection. So it was a bizarre world, but we're going to keep treasuries as a risk-free rate. So a bond. So hopefully you remember this on a bond. Bonds are very straightforward. The forecast is real simple because it's in a contract. As a coupon, and coupon tells us exactly what the cash flow is. So the coupon, now I know on the fact exam, I don't know why they do this. They have a coupon paid once a year. That doesn't exist. Bonds don't pay coupons once a year. They pay coupons twice a year. So I don't know why they put that in the fact. Maybe they just want to keep the exam simple or something. But yeah, treasuries, corporates pay interest twice a year. And what do mortgages do? What's the difference between a 30-year mortgage and a 30-year treasury? So when do mortgages pay interest? You all have mortgages? When would you be paying your mortgage? You going to pay it twice a year?
Once a month.
Once a month, and what are you going to pay? Just interest?
Principal plus
interest. So that's what kind of bond? That's an amortizing bond, right? Mortgages are amortizing. What does the government pay you? Only interest. When do you get your principal back? Very end. Very different securities. So duration is what? Weighted average time maturity using the discounted cash flows. So what has a longer duration, a 30-year treasury or a 30-year mortgage? When you get your cash flows faster, the mortgage or the treasury?
The mortgage.
Mortgage, yeah. I don't know who's online, but yeah. Is that Kyle?
Yeah.
So yeah, mortgage, you get your cash flow. So mortgage may only have a 10-year duration. What do we price 30-year mortgages off of? 10-year treasury, right? Because it's got the same characteristics as 10-year treasury. Because you get, when you amortize, you're getting your cash flows much, much, much earlier, right? Because you're getting principal and interest. So, and that's monthly, whereas treasuries only pay interest in every 6 months. So a lot of that's way out into the future. We also have how much you get at the end, which is the principal, the face value, the par value, the maturity value. We have all these terms. You get that at maturity if it's non-amortizing, which is all we're going to do is non-amortizing. I cannot show you how to value a mortgage-backed security. You might think it's not that complicated, right? You just have the cash flows, you do the present value, but when I forecast the treasury, we know exactly what the cash flows are. As long as the government doesn't go insolvent, you know exactly what you can get for 10 years. Is that true for the mortgage back? You know exactly what cash flows you're going to get on the mortgage back? What might go wrong with your forecast? What if interest rates?
Prepayment risk.
Yeah, they may
Refinancing.
prepay or they may pay more slowly. Mortgages, y'all want to know how they value mortgages? It's pretty crazy. They run, I think, 269 simulations of different interest rates, different prepayments, and they assume each one of those scenarios has an equal probability. They present value of all 269 of those. Each of them is 1/269th, and the value of all of that with the probabilities, that's the value of a mortgage back. So it's quite a complex undertaking. You have to use simulation because you don't know what interest rates are going to do. You can't just present value the cash flows because they're going to change. They're going to be all different cash flows. So treasuries are much, much easier. The discount rate is just the risk-free rate plus a premium, risk premium. For bonds, that's called the spread. We've already talked about spreads narrowing and widening. So we're going to use treasuries as the risk-free rate. And then for corporate bonds, the key there is their probability of default. And then if they default, how much will you get back? That's what's going to determine that spread. And most of that's going to be related to credit ratings because credit ratings agencies are really good at telling you the probability of bonds going to default. So we'll use credit spreads off of the credit ratings. So here's a transition matrix. It's really old. I keep trying to find a more recent one, but S&P and Moody's used to provide their data for free. The last 4 or 5 times I've tried, they asked me to log in. And I can't log in because I don't have an account. So I can't give you these transition matrices. It's unfortunate because if I were interviewing for a job on the credit side, I'd be reading these. I might even go back and read an old one from a few years ago. But these are great transition matrices. So what this says is in year 1 or time 0, a bond that was rated AAA, what percentage of them default? And over 10 years, 0.78% of them default. Not a very high percentage. I'm not saying that they defaulted when they were AAA. By the time they defaulted, they were probably D or triple C. But they were AAA to start with, and over 10 years, they probably downgraded. Because like Enron was AA, but they weren't AA when they went default. They were triple C or single C and D when they went default. Enron's kind of a record, I think, if you went out there. Enron was actually, I think, AA the year they defaulted, and then they were downgraded really fast. So by the time they defaulted, they were not a AA bond, but they were AA just a few months before they defaulted. That's how bad ratings he's got that, but they're usually pretty good. These are great numbers to know. In my risk management class, I actually tell them to memorize these. So AA and AAA bonds, it's less than 1%. So very, very low probability. AA, it's more like 2%. Triple B is more like 5%. Double B, 16, 30. And then when you get down to the triple C's and the C's, it's like you have a 50% chance. Which, when you think about it, you have a 50% chance they'll survive. So if you find one of the 50% that survive, you're probably going to make a pretty big fortune on your money. But yeah, 1%. So what does that mean? 1% over 10 years, you take 1% divided by 10, that's 10 basis points. So on average, for AAA, you expect about 0.1% of default. So if you're paid a spread of 0.1%, if the Treasury is 5% and they pay 5.1, that should cover your defaults. Well, for 10 years, you'll get the extra 0.1%. Over 10 years, you expect to lose 0.78. But this is the default rate. What does this not cover? So if a AAA defaults, you're going to lose 100% of your money. No, you'll probably get 50% of it back. So even that 0.78 is too high. So you probably only need about 5 or 6 basis points to cover you for default risk on a AAA bond, because very few will default, and when they do, you'll get a lot of your money back. All right. So AAA, AA, where is high quality? All the A's, medium quality, triple B's. You might say, well, that's only one category, but a lot of bonds are triple B. Below investment grade, double B's, and then the D's aren't on here because a bond starting as a D, I mean, it's not going to last. It's already default, so it's not going to last 10 years anyway. It's going to be 100% in the first year. So all rated securities, about 10% of them default over 10 years, which means you take 10% divided by 10, that's 1%. So 100 basis point spread on average will cover it. Bonds pay a whole lot more than 1%. They pay more like 2 or 2.5%. So you're covered pretty handsomely for credit risk. Why? Because when 2008 happens, you're so devastated that the averages don't really mean much. You just lose so much money all in 1 year. So this is a good. I wish I could find a more current one. You could carry that around in your wallet. It does include 2008, so there is one really bad year in there, so that helps. All right, so let's just do it. The best way to do this is just to do it. So we're going to price a Treasury. So let's say we bought a 30-year Treasury 20 years ago. On your birthday. And back then, well, there weren't, that's back when the government had so little debt, they paid off all the 30 years. It was pretty hilarious. I was at a conference where they asked the Treasury if they'd ever have 30-year bonds, and said, we don't really think we'll need them ever again because the debt level is so low, and they've solved that problem. So we didn't have 30 years back then. So let's go back to 2013. Let's say we bought a 20-year bond 10 years ago. And so that yield was 3.29. We'll say that's the coupon. So we're going to buy a 20-year Treasury issued 10 years ago. So what kind of bond is this? What do you care about? It's not a 20-year bond, is it? What is it to you? It's a 10-year bond, right? That's all you care is 10 years. That's all you care about is how much time is left. The coupon is 3.29%, but what is the yield? So we come back to today. What yield do I use today? Do I use that yield or that yield? 486, right? Because it's a 10-year bond. Have y'all noticed how bonds have rallied the last couple of days after jumping to 5%? I don't think it ever closed at 5. People kept saying it hit 5. It's not in the numbers, so if it hit 5, it did it so fast, people didn't get time to record it. So 486. What do you think about a bond that's paying you 329 in a market where you can get 486? Do you like that bond? Did you sell that bond for par for $1,000? You'd like to, would you? But you like to sell that bond at par and go buy a 4 point whatever 86% bond. So if you want to sell that bond, what are you going to have to do? You have to
Take
cut
a
it.
hit on the price.
Yeah, give it a discount. So we're going to discount it. But what is the discount rate? Well, what did I say? The bond pays coupons how often?
Semi-annually.
All right. So the discount rate is going to be the effective yield. There's no R in effective. So what is the effective yield? So what the effective yield says is take that yield that's an annual number, but change it to reflect the fact that it pays twice a year. So what you do here, you're going to take 1 plus the yield divided by 2, raised to the 2 minus 1. Okay. You're dividing by 2 and raising it to 2 because it pays twice a month. What if this were a CD? What would you do? How often do CDs pay interest? Usually what?
Quarterly.
I'm going to say monthly. I mean, I guess it's possible it's quarterly. Some pay daily, but we'll say monthly. If it's monthly, what do I do? 12 and raise it to the 12. All right. If I do that, what do I get? I get the APY. Have y'all heard that before? So there's a stated rate on the CD that might be 5%. The APY might be 5.10. The APY is what you get if you reinvest those interest payments. If you take your interest payments out, you're not going to get the APY because you're not reinvesting. They automatically reinvest at the yield. So that's the APY. It's the same thing here, but here we call it the effective yield. So CDs, they call it the APY, the annual percentage yield. For bonds, we call it the effective yield, but it's the same thing. So I'm going to take 1 plus that divided by 2, raised to the second minus 1. If I get 479, what do I know for sure? Did I do it right or do it wrong? If I get 479, had to have done it wrong. Why? That number has to be what? Has to be higher than, because you know the APY is higher than the stated yield on the CD, right? It has to be higher. So if you get a lower number, you did something wrong. So that's something on the exam. I don't count out for math errors on exam unless you should know it's a math error. If you get 479, you don't have enough time, you can write a note. I know it should be higher, but I don't have time to fix it. Then you'll be okay. If for some reason you type 468 instead of 486. All right, so 429 is the effective yield. Now, we're going to do some estimates. This is actually my favorite part of the entire course. When you take John's class, I don't know if he does this, but I love this part of the course because it really shows you all about a bond. So we know that a bond's price, y'all remember the formula from exam 1? Minus times the change in minus duration times change in what? In yield.
Yield.
All right, so here, the duration of this bond, I'm going to guess, we'll actually calculate it. I'm going to guess 8.8. I have no idea if that's right because I can't do duration in my head. Why not 10? Well, because you're getting some interest payments in advance, right? So that's going to shorten it from 10. And so I'm going to say my price change guess is going to be minus duration times the change in yield. Well, the yield today is 4.86%. When we bought it, it was 3.29%. So that's going to be my guess. So the bond price should be down 13%. So price estimate, it's going to be $1,000 times 1 plus that. So I'm going to start off with a guess that this bond's price is 661. Did I do that in y'all's class? Can't remember read this far. That's my guess. All right. Then I can use the formula. Now you can use your calculator, but if you use your calculator and get the exact right answer to the penny, you get 0 credit. All right? You have to do what I'm doing here. Because I don't care that your calculator knows how to do it. Because your calculator is not interviewing with for jobs. You have to know how to do it, and you have to know what your calculator is doing. All right. So what is your calculator doing? So let's take the value of the coupon for infinity plus the value of maturity minus the value of the coupon for infinity. But we're going to take the present value of this. That's what your calculator is doing. Let me say, I never get it right the first time, but maybe this will be the first time. So what's the value of a cash flow that you get for infinity? The cash flow divided by your discount rate. All right, that's pretty simple. So what's my cash flow on this one? So you're going to get, well, let's do the face. We're going to say that the face on the exam, I always use $1,000. That's just the assumption we're going to make. So my coupon is going to be $1,000 times 329 divided by 2, right? Because I get it twice a year. So I'm going to get $16.45 every 6 months. What's the value of $16.45 for infinity? So I'm going to take $16 divided by 486 divided by 2. So if I were getting $16 for all in infinity, that should be worth $676. Am I getting $16 for all of infinity? I'm only getting it 20 times. So what am I going to do with that? Well, I need to add some stuff to it. What I'm going to add? Well, I'm also going to get $1,000, right? But I'm not going to get 1675 for all of infinity. I'm not going to get that after 20 payments. So I need to subtract that, but I need the present value of that. What's the present value of that? So I take 1 plus the discount rate divided by 2 raised to the what? How many payments are there? 20. Well, 2 per year, but 20 over the entire time. Now, what's the chances I did it right? It's pretty low, but we'll see. There's always hope. Does that look like it could be right? Well, maybe I got it right the first time. Who knows? That is a bond. When you do your present value interest factor in your accounting books, what are they doing? Exactly that, but without the $1,000. That's what the formula is, right? They're just saying, hey, if I had this for all of infinity, here's the formula, but it stops at some point, so I have to subtract that out. That's all that present value interest factor really is. Pretty straightforward. And all I had to do to that formula was just add the $1,000 discounted back. We'll see. What you have to do on the exam, though, is the table. All right, I'll require that because I want you to actually see it. Plus, I want you to know how to calculate duration. So to do the table, we're going to have time. We're going to have cash flow. We did do this in your class, Brandon. We have the discount factor. We have the discounted cash flow, and then we'll actually calculate duration. You don't need to do that on exam. I'll have a few students that show off and do it, but you don't, it's not required. I always like students that show up. So when's my first cash flow come? How many years from now?
0.5.
0.5, exactly. And then the next one at 1. So we go down to 10 years. Oops. There's my time. Now on the exam, I'm not going to give you a 10-year bond. I wish we could do the exam in Excel. We can't, but I'll give you probably a 2-year bond because you can handle that in the table. But here we can do this. What's my first cash flow? How much?
Is it 0?
No, in 6 months, what are you going to get? It's on the page somewhere. 1645, right? What will you get in a year? 1645. Anybody disagree with that? When do you not get 1645?
On the final year, you get that plus the par value.
Back the $1,000 back. All right. See, Cal, we need you here, man. All right, so there's our cash flows. What's my discount factor? Here's where you're going to use the effective yield, 492, raised to the time. That's going to be your discount factor. It's got to be below 100. On the exam, go out 4 decimal places. Why do accountants always go out 4? Because we have dollars and cents. Because we go out 2 decimal places. If you use 4 decimal places and a discount, you won't have so many rounding problems. All right. I won't have any rounding problems here because I'm using Excel. So there's my factor, my discount rate. But here I have to use the 492. We could use the 486, but if we use the 486, we'd have to divide that by 2, and then we're going to use 1, 2, 3, 4. So there's different ways you can do it that makes it work. There's my discount factor. You know it has to be less than 1. You know it has to be decreasing as you go. Okay. What's my discounted cash flow? You just multiply across. How much is $16.45 worth? If I get it 6 months from now, how much would I pay for that today? I pay $16.06 today. And so each one of these is going to decline until the very end. Then you get that amount back. So what's the price of my bond doing that? It's just the sum of all of these. Does that look right? Looks pretty close, doesn't it? How good was my estimate? I'm kind of proud. I didn't do too bad on that. My estimate could be wrong because my duration's wrong, but why else it could be wrong? Why would a bond's price be higher than what duration says? Anybody remember from exam 1?
Convexity.
Convexity, right? What does convexity do? It's going to give you a higher price than what duration says. So let's see. I guess 8.8. So what is duration? Remember, duration is the weighted average time to maturity using the discounted cash flows, not using the cash flows, using the discounted cash flows. So there's time. There's my weight. Everybody agree, right? Copy that down. And I'm going to divide it by the price because the weight is $16 over the final price, okay? So I'll copy that down. So how close was I on duration? This is Macaulay duration, so it's not quite so accurate. So I was a little too high. It's actually 848. I'm surprised Bill Gates did this formula, given how many spaces there are in the, I mean, he just assumed I wanted all this, which is good. So 866 versus 876. So this bond obviously has some positive convexity. Now you have modified duration. This is Macaulay duration. Modified duration is going to be a little bit more accurate, but it's not going to be a huge difference. You can look that up in Wikipedia. Probably in John Tui's class, you'll get into modified. There's Macaulay, modified, and effective. And then there's a couple of other wild ones that I've never dealt with. There's even spread duration. There's some other ones. There's so much in this little spreadsheet about bonds. It's pretty amazing what you can do, right? It's really powerful. You can't do this with stocks. You don't have all this quant behind you to do this kind of analysis. So this bond is trading at a discount. Why? Because the current yield is greater than the coupon. If it gets someone to buy this bond from you that's only paying $3.29, they can get 4 something. You're gonna have to give them a discount. Any questions on that? Could y'all do this in Excel off the top of your head without looking anything up? If you're a finance major, you should be able to. If you're an actuarial major, you should be able to. Life actuaries can do this better than finance majors can. So it's pretty critical that you understand all of these pieces. Can you do it on your calculator too? So if you have a calculator that does it, you don't get credit for that, but you can double check your answer. What's required for the exam is this. And again, I'll probably only do 2 years instead of 10 years, but that's what you have to put on exam. I want that you can actually see what the bond calculation is. All right. Because once you graduate, you may never touch a calculator ever again, unless you're calculating a tip at a restaurant somewhere. But you're not going to use it on the job. I needed a calculator to go into a meeting once, so I asked Jason to borrow his calculator. He took it out. He had to blow the dust off it. And this is an expensive, one of these HP expensive calculators. You never use. Why? Because you have Excel sitting on your machine. Excel will do the same thing. I can never remember how to do it. So our rate is that divided by 2. Well, the payment is that, comma.
You put it for numbers first, I think. For the number of things instead of one.
Oh, I left the new, that's 20. Yeah, I'm not good at using these formulas. The future value is $1,000. So yeah, I got a spill problem, whatever that means. But Excel will do it as well. I just never use Excel formulas because this one is a lot easier formula for me because it makes sense. It's exactly what the math is. I don't know what Excel's probably doing that, right? They're doing that exact math. To me, it's a lot easier just to plug in the actual calculation and not have to. So you don't want to get in the habit of memorizing formulas that have nothing to do with the problem you're doing. Like how to put in my calculator, how to do in Excel. You want to do it the way the problem is actually, the math you're actually looking at. So I prefer this formula. That's not that hard of a formula, right? It's pretty simple formula. So you don't have to use this formula on exam, but you certainly could show off on exam and use it just to see if you have it right. It takes 5 seconds to plug into your calculator and you've got the answer. It's even faster in Excel. All right, let's do another one. Let's do a corporate. This one we should have just enough time to do one corporate and then we'll do another one next class. All right, so let's go back 15 years. Whoa, 2008 is kind of a strange year, right? And we got a 15 years. So, wow, look how steep the yield curve was back then. 63.34. Let's just say 4%. So we're going to do a 15-year corporate. Oh, I went 20-year, sorry, 20-year corporate issued 15 years ago. So I pulled the wrong number. All right, so we'll do a 20-year corporate issued 15 years ago. So 20-year, 15 years ago was 434. Thanks, Bill Gates. I don't know why you did that. All right, so when this bond was issued, it was single A rated. Today, it's triple B rated. Right, which rating do you care about? Triple B, right? So spreads in 2008 and 2023. 2008, the spreads were, say, 15. Now they're 20. B was 185. Now they're 200. What are these numbers? 200 what? $200, 200%. Any guesses on what that 200 is? I mean, what could it be? 200% be pretty high. Told my pastor the bank was going to give us prime minus 15. He's like, wow, prime's 9% minus 15%. They're going to be paying us money. They weren't giving us prime minus 15%. They're giving us prime minus what? 15 basis points, right? So these are basis points. So what is 200 basis points?
2%.
You just divide by 10,000. All right. So the coupon is going to be 434 plus 0.0015, right? The risk-free rate back in 2008 was 434. The spread was 15. So this bond has a coupon of 449. That's the coupon. What is the yield? So what kind of bond is this? Which risk-free rate do we want to use? It was a 20-year bond, but it's not a 20-year bond now, is it? What is it now?
5-year bond.
5-year bonds. So we want to use 481. So these are the spreads for 20-year bonds. Here are the spreads for 5-year bonds. A 5-year bond will have a wider or narrower spread than a 20-year bond. Any guesses on that? If you're going to loan someone for money for 5 years or 20 years, are you more worried about going to default in 5 years or more worried about them going to default in 20 years?
20 years.
20 years. So there's something called the term structure credit spreads. So we know how the yield curve is normally upwardly sloping, except for right now, because it's a little riskier because of inflation a lot longer. There's also an upward slope on spreads, which is there's not inverted. I've never seen that one going the opposite direction. So they're always higher. So 5 years should be a little lower. Maybe it's 10, 15, 170, and 185. So which spread are we going to use? So you know, reject this. It's not a 20-year bond, right? We only needed this when we issued it. So when we issued it, that goes there. But what kind of bond is it now? We don't care about 2008 anymore. So it's not a single A rated bond. It's a triple B. So we're going to use that. So our spread is going to be 185. And what's our risk-free rate? Risk-free rate now is 481. All right, that's the risk-free rate for a 20-year. This is risk-free rate for a 5-year. Right, so at issuance, the bond is going to be at par. They're going to take the risk-free rate 15 years ago, the spread 15 years ago. That's how they're going to price it. So they're going to issue the bond, so it's exactly the coupon and the yield are exactly the same thing. But over time, the spread's going to change, the discount rate, the risk-free rate is going to change. So this bond right now has a yield of 481 plus 185 divided by 10,000. Remember, you take basis points, you divide by 10,000. So is this bond going to be trading at a discount? Ooh, that's evil yield. A discount or a premium? The coupon's 449. Our yield is 666. Can be a discount bond, right? The effective yield is going to be 1 plus that divided by 2. Raised to the 2 minus 1. If it gets 682, could that be right? Could be. Whoa. -1, hit the wrong button. Or 677, I went a little too far. So 67 could be right because it's higher than that yield. All right, let's guess. I'm going to guess a duration of 4.5. So my price guess is going to be minus duration times our ending is 0.666 minus 0.0449. Bill Gates doesn't like that. So my guess is going to be minus duration times my ending yield minus my beginning yield. So I'm guessing this bond has fallen about 10%. $1,000 times 1 plus that. Now, why did it fall? For two reasons, right? What did the risk-free rate do?
It rose.
What did the spread do? It widened quite dramatically, right? So probably more of this is due to the spread because the spread went up 170 basis points, but the risk-free rate only went up about 47 basis points. So most of this price decrease is because of the spread widening. Okay, and you could actually, that's why they talk about spread duration. It's how much impact on the price does a change in spread have. All right, let's figure out the price, see if I can do this one. So we're going to do the coupon. So what is the coupon? So you got 1,000. Well, let's put the face up here. Face of $1,000. So the coupon's going to be $1,000 times 4.49 divided by 2 because we pay twice a year, all right? So using the formula, I'm going to get cash flow for infinity, which is that, divided by 2. So that coupon, if I got it for all of infinity, would be worth $674. But I'm going to add to that the $1,000 minus that divided by B15 divided by 2, right? You see how those are the exact same thing, right? That minus that. Why? Because this is for infinity, and then I'm going to subtract out anything after 5 years. And I'm going to divide that by 1 plus discount rate divided by 2 raised to the what in this case? It's a 5-year bond. So raise it to what? To 10. It's a 5 years. So raise it to 10, right? Because there's things a year.
There's.
Does that look like it could be the right answer? What, I'm 2 for 2. Looks pretty close, doesn't it? And then you do the table. So we have time, cash flow, discount factor, DCF, and then I'm going to do duration. So time, same thing as before. I can type. And then our cash flow is 2245 until the very end. The end, we get our $1,000 back. Bill Gates is not helping me out here at all. But anyway, and then our discount factor is 1 divided by 1 plus our effective yield raised to time. Oh, yeah, Bill Gates hears me complaining about him, then he messes me up even more. So that raised to time. It should be 0.9 something. Copy that down. Make sure you lock in the yield. Discounted cash flow. The table values is the sum of that. Let's see if we get the same answer. Looks pretty close, doesn't it? And the duration, time times the cash flow, weighted average cash flow. So the actual duration was pretty close on that one. Wow, amazing. So what happens to the duration if interest rates rise? Can you do that in your mind? Interest rates rise. Remember, the $1,000 is the biggest cash flow, the biggest weight. If interest rates rise, what happens to the present value of that $1,000? It's going to go up or go down? It's going to go down. So that should reduce duration, right? Because you have less weight on that 5 years. As interest rates rise, durations fall. Remember, that's one reason you get that positive convexity. Because rates are rising, but your duration's falling, so you're not getting as much price hit. All right. So see how much is in this one little spreadsheet. You can explain a massive amount of the bond market. So my estimate was off a little bit, but not too far off. So this bond must have quite a bit of positive convexity because you get an extra $6 and it's only a 5-year bond. Anyway, all right, we'll practice this some more. And then I'll also show you exact exam questions so you can see exactly how it's going to come up. All right, we'll stop there. I don't want to start something new. All right, so pretty straightforward, right? I personally use geometric, but dollar weighted. You can't do dollar weighted or CPA Institute because supposedly you don't control when your investors invest. You know, they may invest on Monday and the market's down on Tuesday. You don't want to get penalized for that. But if it's my money, I am making both decisions. Right? I decide when the money goes in. So I do a dollar weighted. The wealth management class we're doing the investment society. That Excel spreadsheet I set up actually does a dollar weighted, which is your true return. Why is that important? Well, studies have shown the overwhelming majority of Americans have no clue what their portfolio return is. They don't know. A lot of them, in fact, I did a study when the market was up for 2 decades and did nothing but make money. The majority of Americans thought they were making money, and the majority of them were actually losing money. They were such horrible investors because they don't know the returns. You don't know returns. So this is pretty important. This is one approach you can use. I prefer my approach because I think it's more accurate, but this is the one approach you can use. So the income, where does the income go? In March, and it's $1.15, a pretty big dividend, although it's a $200 stock. So the holding period of return is just going to be ending market price minus beginning market price plus income divided by beginning market price. That look right?
Yep. Yeah.
You get 13%. Oops. Now, y'all seen how the minus sign in front of the 13. I'm not sure what happened there, but anyway, one team did. All right, so it's nothing but positive numbers. Well, that's kind of positive, but it's only 3 months. We do the Arith average. That's just an average. Does that sound right, what y'all were getting? Any team that sound familiar? And then you annualize it. Pretty easy. You just take the monthly times 12, right? That's real easy. Y'all get like 119%. It's going to be a massive number. Your stock's doing that well. It's pretty massive. And then the geo, you just take each one. Take all of that. So what is that number telling you? If you'd started with $1, you'd have $1.33 today. That's what that link is telling you. So someone's asking, why did I divide by 1? Because I'm assuming I started with $1. So it's ending, the geometric is ending over beginning, but you're linking that beginning. You're assuming you had $1 invested, you made 13% the first month, so you have $1.13. Then you make 4%, not 4% on a dollar, but I'm going backwards, right? So start with January. So you start with $1 and you make 11% the first month. So you end up with $1.12. The second month you make 4.83, but you don't make 4.83 on a dollar, do you? You make 4.83 on what? $1.12. So it's compounding. And then the next month you make 13% on that $1.16 or whatever you have. So to get the average of all of those, we want to raise it to, we're doing monthly, so there's 1 divided by how many months do we have? We have 3 minus 1. If I get 10.4%, could that be right? Has to be lower than what? Has to be lower than 992. All right. And I get 986. Does that sound right, anybody? That number sound right? And then we're just going to do that again. Except for the annualize, what's the only number I change? 1. Yeah, 12 over 3. Here we can get a higher number. In fact, we probably will because those are massive numbers. When you take 9% and you link it, compound, you're going to get a massive number. So that number, I mean, that'd be a really nice stock to be in if it just keeps averaging 9%. What would you make, say, in 7 years? Any guesses on that? What would $1 be worth if you could make that 9% a month over 7 years? Is it a big number or a small number? Yeah, I've heard the question, you know, would you rather get $1 million or a penny double on each part of a chessboard? Which would you rather have? I'd rather have the penny double, right? So $2,000. What if you could do that for 20 years? I don't know what that is. $6 billion. If you could do it over your life. Why is that important? I heard a commercial. I love these commercials that insult finance. The commercial's whole thing was if you have the 5th grade education, you can do what the Wall Street professionals do. I don't think that's true. But the commercial, one lady says she was making 9%, 7% a week without risk. It's like, well, that's pretty good because in a few years, she's going to be wealthier than the entire world's wealth put together. That's really, I think she said weekly. She made 8% a week. I mean, weekly, 8% a week, 4 years. You're going to have a lot of money. That's $1. It's going to be a lot of money. She didn't start with $1. She started with thousands of dollars. So she'd be buying Bill Gates out. It's like, man, you poor people. I don't know how y'all get by on just a few $1 billion. So it's not possible, but that's what the commercials say because no one scrutinizes what they say. But easy question. A lot easier on Excel than it is in on paper, but we can't get Excel on the exam. So, all right. So we're going to do another corporate bond and talk a little bit more about it because I want to get a little bit more. There's so much we can do on fixed income. I don't know how many of y'all are going to take John's class next semester, but highly recommend it. Get a lot more in depth in what we're talking about here. Well, let's try a, let's see. Let's do a 20-year bond issued 15 years ago. An issuance, and that's a 20-year bond, not 29. At issuance, it was rated BBB. And the coupon was a risk-free rate plus a spread. So when it was issued, what risk-free rate would they have used? 15 years ago, they would use what treasury? And what bond is it today? What kind of bond is it? It's a 5-year bond. When it was issued, it's a 20-year bond. So what treasury would they use 15 years ago? The 20-year bond, right? So 15 years ago, look at the 20-year bond. $15 is 2008, right? That's kind of an interesting period, October 2008. The 20-year bond back then was 444. Not radically different than today. And the spread, it's a triple B bond. I'm going to show y'all spreads here. I actually have it, so let's go look it up. So triple B bond in 2008. Oops, too far. Pretty wide right back then. So actually 652. Why? Because they're middle of a crisis. Okay. That's a high yield bond yield, 652. But back in 2008, triple B bonds were yielding higher than high yield bonds are yielding today. So 652. What's our coupon? 444 plus 652 divided by 10,000. So it would have been yielding 10.96%. This bond's still in business today, it's probably got a really good price, you would think, right? Because interest rate, the 10 years up, but what do you think that spread is? Well, let's say today, the term is obviously 5 years. And the spread, let's say the rating today is single A. So the risk-free. So what risk-free rate do we use today? The 5-year treasury, right? Because it's a 5-year treasury today. So we go back to the present. The 5-year today is 482. So what is that going to do to the price? The risk-free rate went from 444 to 482. That's going to do what to the price? Going to pull it down some, right? Interest rates rose. But then the spread, what do you think the spread's going to be? Now, I don't have spreads for 5 and 20, so I can't do that. So I'm just doing the average spread for all denominations. But single A today is 107. What's that going to do to the bond price? So you expecting this bond price to be higher or lower? Over 1,000 or less than 1,000? Interest rates went up. That implies it should go down. But what did spreads do? They didn't narrow, did they? They collapsed. You don't use the word narrow. Yeah, the spreads narrowed a little bit. No, they collapsed. Why did they collapse? Because 2008 was a crisis. And because you can look at triple B bonds, they collapsed as well, right? They fell all the way to 147 from 600. So they collapsed, but this bond also got upgraded. That was another 50 basis points. If you're talking about why this bond's price is up, the biggest factor was the crisis. Spreads in general came down. The second factor was it got upgraded. And then an offsetting factor was the real rate was, interest rates were a little bit higher. So you got those three things together. That's why they talk about spread duration. This bond is going to be up in price, but spreads collapse so dramatically. So what's my current yield? Plus that divided by 10,000. Oops. Plus that. I don't know what I did. 589. So this bond went from 1096 to 589. And then the effective yield. So in the factory exam, they don't make you do the effective yield because for some reason they give you an annual bond, but we know bonds aren't really like that. So effective yield, real simple, just take the yield divided by 2, raise it to second minus 1. Real similar to what you're doing with the geometric average. You're compounding the interest. So 598. So I want to get this bond's duration and convexity so we can get a little bit better estimate. So this bond pays a coupon. Its maturity is 5 years. The coupon is whatever I said it was. I can't remember. 1096. And the yield, not the effective yield, but the yield is 589. So this spreadsheet is out there. You can use this spreadsheet. So the duration for this bond is 397 and the convexity is 2117. Doesn't have a lot of convexity. Why? Well, because it's only a 5-year bond. All right. So our estimate, and I won't have you do this on the exam because unless you're really too advanced with this class, I doubt any of y'all can calculate convexity, and I doubt any of y'all have calculators will calculate convexity because you'd be sitting there inputting numbers for like 6 hours, but you can get it in a spreadsheet. So why is that helpful? So you'll notice I give you the formula right here. The change in the price is minus duration times the change in yield. So that we already know, right? Plus, why? Because convexity helps. Duration hurts you, rates rise, your price falls, but convexity helps you unless convexity itself is negative. But here we're adding convexity times the change in yield squared divided by 2. Let me put that in there so you can see what I'm doing. And let's see if that gets us any closer. So the estimate duration only is going to be minus duration times the change in yield. What did yields do? They fell to 589 from 1096. So that means the bond should be up 20%. The bond should be trading for about 1,000 points. All right. What if we do duration and convexity? Is that going to make it higher or lower?
Higher.
It'd be higher, right? So plus convexity, plus the change in yield. Now you say, well, that's a negative number. That's going to hurt, isn't it? But what are we going to do with that change in yield? We're going to square it, right? Plus the change in yield divided by 2. I forgot to put convexity in there. Plus convexity times. So with convexity, it tells us the bond price should be 22, whatever, 22.92%. So $1,000 times 1 plus that, or $1,000 times that. Those are, which estimate should be more accurate? The second one should be more accurate, but we'll see how close we get. On the exam, you don't have to do the estimate. I'm just always impressed when students do. Why would it be good to do the estimate? Because in an interview, you can do that in your head. Quite an advantage. I had a boss, he was the treasurer at UTSA, and he used to do that calculation all the time. He was always showing off. Yeah, the bond's down by 6.2%. Yeah, how did he do that? Well, he wasn't doing convexity, right? He's kind of rounding it. You can jump in.
Left something behind.
Okay. You see it?
Yes, they're gonna leave it behind. The brown corner.
Brown something like that.
All
right.
I'm sorry.
No problem. No, it's frustrating to leave stuff. All right, so that 1,200 is not that bad of an estimate if 1,229 is the right answer. Now, neither is going to be correct because the convexity doesn't have to be correct. But let's see. So then we can do the formula. Anybody do the formula off the top of their heads? No takers. So the first thing we do is we take the coupon. Let's get the coupon first, right? So the coupon is $1,000 times that divided by 2, right? Because it pays twice a year. So the first thing we do is to take the coupon and divide it by not the effective yield, but the yield divided by 2. That's the value of the coupon for all of eternity. Why is it such a massive number? Because interest rates were 10%. All right. So that makes a big difference. Then what we're going to do is we have to take the $1,000, right? We haven't accounted for that yet. But then we don't get that coupon for all of eternity. So we're going to subtract that, C8 divided by B14 divided by 2. We're going to subtract that, but that's all 5 years from now. So we're going to divide that by 1 plus the current yield divided by 2 raised to the what? Not 5, but that's the right area. How many payments are we going to get? You do it in N. N is a year. N is number of payments. How many payments are we going to get? 10, yeah. Y'all tell me, when I hit enter, you tell me if it looks right. Could that be right? That looks pretty good. Our convexity numbers kind of overstating it. That's probably right, but we'll see. All right, so we'll do the table. We got time, cash flow, discount factor, discounted cash flow, and then we'll do duration again. I believe this duration, I have to go back and look in the spreadsheet. I think it's Macaulay. Yeah, it's Macaulay duration. So it's going to be a little bit different. Macaulay duration, I mean, not Macaulay, it's modified. The 397 is modified. And I'm calculating Macaulay. It's going to be slightly different, but it's not going to be radically different. So there's my table. The table is what you have to do in the exam. And we will have a team question on the tables. So we'll get a cash flow in half a year. We'll get a cash flow in a year, all the way out to 5 years. Everybody with me on that? So you have 10 cash flows. On the exam, you only have 4 cash flows because I'm going to give you a 2-year bond. So you don't have a million cash flows. I'm assuming you can do 2 years. You can do 5 years. Then the cash flow, we already got that, 5480. And that goes all the way down until the very end. We get our $1,000 back. Discount factor, 1 divided by 1 plus. Here's where we use the effective yield. Raised to the time. Oops. Bill Gates. Those of us that learned pre-Excel, you didn't have to do the equal or plus sign. You just started typing the formulas. Some of us are still old school. We forget we can't do that. Effective yield, lock it in, raise the time. And it better be 0.9 something. About 4 decimal places, copy that down. Cash flow over. I don't know what all that is. What did I do there? Whoa, I have no idea what I just did there. I lost my formula. Yeah, I don't know why it would have done that. Wow, that's terrible. Okay, I'm going to go back. So I can do the table much faster than I can do that. Okay.
Plus works too.
Plus is fine, yeah. Why do I do plus and not equal? That's a plus sign's right there. The equal sign's way over there. It saves you 1/10 of a second. Take 1/10 of a second times 1,000,000 times a year, and you'll be going home 5 minutes earlier. But I have students tell me, why you're so fast in Excel. If you're saying that, you've got a serious problem, because I'm not fast in Excel. I'm actually quite slow in Excel. So if you're sitting there thinking, man, he's really fast on Excel, your Excel skills are not where they need to be. How do you get them where they need to be? You spend 2 or 3 hours a day learning Excel, because it's you've got to know it. How do you do that? You go on YouTube and do Excel is fun, or you go to the Institute of Corporate Finance and you watch a video of theirs every single day until you can do all of the stuff they say. And then what does The investment society say, how do you know you're using Excel correctly? You never touch the mouse. Never touch the mouse. Y'all can see I touch the mouse all the time. It was funny when we first got spreadsheet, there were no mice. They didn't exist. And you should have seen this. People used to come watch me key. They thought I was just goofing off. I was like, no, I'm actually doing stuff. We got so fast. And the mouse showed up, slowed us way, way, way down. Now you are getting back to non-mouse because it is a lot faster to do stuff without the mouse. And I see students, oh man, the thing that drives me bananas. Oh, I bet there's some people in this class that do this. They'll go plus that, and then they'll do this. Oh my word, it gives me a heart attack every time I see that. It's like, I can't believe you're doing that. What would you do? Just copy it down, right? But oh, it's just like, what are you doing? You're gonna kill me. I'm gonna sue you. So, all right. So let's see if we got the right price. Looks pretty close to me. I don't know why convexity is off so much. I might have keyed something wrong in the convexity formula. Who knows? The duration looks about right. Duration seems really low for a 5-year bond, but this coupon's pretty high, 6%. So that may be why it's down. It's possible I keyed something wrong in the spreadsheet. The 1216 looks right, so I would have had gotten everything else right. But yeah, it's just convexity. Convexity can be a little tricky when you're at these more extremes as well. That coupon is massive. That 50, $100 on 1,000. I mean, that's like a stock return, isn't it? You're getting 10% yield. And that's what I bought a bunch of high yield at the end of 2008 because you could get 18, 19%. It's like, why buy stocks? If bonds have first call on the cash flows, why would you ever buy the stock of that company when you can get their bonds at 18%? So, all right. So the duration convexity got us too high. Duration by itself got us too low. It looks like it's right in between those two. So yeah, who knows? If I had not such an extreme bond, it probably been a lot closer. All right. So we'll have a team competition where you see just like it's been on the exam. Maybe I've figured out the video yet. The video is your exam review. So you just can work through that. The format will change a little bit just because interest rates are so much higher now. Any questions on that? Or now, should you be able to do that without any notes off the top of your head? Absolutely. This is real basic finance, valuing a bond. It's on the fact exam. The fact exam is a little different because they want you to use your calculator, which is a complete waste. But the fact exam does let you use Excel now. Have y'all already done the fact exam, or you had to do it for this class? Did y'all do Excel or use your calculator?
Excel.
Excel.
I think it was.
Now, Excel, you're probably using the formulas. I wouldn't use the Excel formula because you're not going to. Excel formulas is a black box. You don't know what Excel's doing. You see why I like using a table. So you can see exactly what a bond is. This is the present value of those cash flows. So I prefer you build. If you spell do everything I did off the top of your head, look, I mean, y'all didn't see me looking at any notes, right? So you just plug it in and go. Now duration, you just take time times the weighted average of time of cash flows. That's just each cash flow divided by the price. So the duration can be a little bit higher than this. So modified duration, Macaulay duration is 4.09, modified duration is 397. 397 is more accurate. You can see if I had used the 409, I would have gotten even higher than the 1229. So it would have pushed me even further away. So the 397 is more accurate. I don't know who Macaulay is. I don't know who fixed this formula. I would have just called it Macaulay duration and given him the correction. So now you got Macaulay modified. So what other versions do you have out there? So I can't spell Macaulay, but I'll try. Surely someone will fix it for me. So bond duration. So here's Macaulay. So does this formula make sense now? So the present value of the cash flows in 0 through n, what is that? That's that 12, whatever, $1,200, right? That's the price of the bond. What's the only difference in the numerator and denominator? Someone yell it out. I know y'all see it. Time. That's the only difference. Those 0.5s. So you see, they're doing exactly what I just did, right? Does this formula look complicated? Y'all can do the summations, right? It's pretty straightforward stuff. So that's what Macaulay duration is. Then modified duration is they just take that and they adjust it for the yield. They just essentially divide by 1 plus the yield. So it's not a radically big difference in the change. Are those the only durations? There are other durations out there. Key rate duration is something we used at USAA. It was really cool. So when I was at USAA, any chance I had to go talk to an actuary, I did. And you would have thought they hated this, this stupid kid because I wasn't as smart as they were. But they loved it because no one ever talked to them. No one knew what they're doing. They're just hoping they did it right, because if they didn't, the whole company was going under. They're the most important people in the company. But so quantitative, people are just like, I sure hope you know what you're doing. Because they set all the prices for insurance products. If they're wrong, the whole company goes under. But I remember talking to the guy in the life insurance company. He did key rate duration, which means what he did is he made sure they weren't exposed to a duration anywhere on the yield curve. How's our 5-year bucket look? How's our 6-year bucket look? And then the bond manager would say, well, John, I can't. They're both named John. The actuary and the portfolio manager are both named John. So say, John, I can't buy any 6-year corporates right now, but I can buy 8-year corporates, and I can buy 4 or 5. And he would say, well, put 40% in 4 years and 60% in 8 years. And now, what John was saying, I got to get the right key rate duration. I got to get the right convexity. You wanted both of those together. Convexity is huge for life insurance companies. Riley's going to see that in my life insurance class, and Elizabeth too, right? So they're going to see in that why life insurance convexity is so much more important than in banking, because life insurance companies' liabilities are incredibly positively convex. You love convexity when you have a bond. You don't like convexity when you have a liability, right? Because that's going to really hurt you. So life insurance companies, they got to manage this extremely well. So that key rate duration is something a bank would never do. That's like overkill, but a life insurance company would do that and be extremely precise in it. So there's a lot here. You can see the math is not horrible, but it can get pretty serious. So what do you do when you have a mortgage-backed security? What does a mortgage-backed security have? Y'all remember embedded options? A lot of y'all wrote that on the exam. What's the duration when you have an embedded option? We have no clue, right? Because what happens when interest rates fall? You got a 30-year mortgage, interest rates fall, what do people do? Refinance. Do you have a 30-year mortgage? No, you have a 1-year mortgage. So what did duration do? It went from like 18 years to 9 months, just like that. And what if interest rates rise? People slow down their payments, your duration. That doesn't happen with the Treasury, right? So that's when you have something called effective convexity. Effective convexity is well beyond an undergraduate course, extremely advanced mathematics. Essentially what they do with the effective is they change the interest rate a little bit. What if it falls 10 basis points? What if it goes up 10 basis? Reprice the bond. Remember, they go out and do the 269 scenarios, and they see how much that changes. There's a big difference on key rate duration if rates fall 10.1% or they fall 1%. You get radically different changes. This is a very complicated bond. You notice here they have the Black-Scholes equation. What is Black-Scholes related to? Options. When we're talking about bonds, well, what kind of bonds are we talking about? Bonds with embedded options. You can actually use option pricing theories. So I'm just trying to let you know, bonds, you probably thought they were these really boring things. Like, who wants to do bonds? That's boring. They're not boring. They're far more quantitative, a lot of math, a lot of opportunities. You can make a fortune doing bonds. I have lunch with Victory Capital on Monday because they want to hire UTSA students. I'll probably give them the names of students in their class. because they want some interns. That's a pretty cool firm. But what does Victory Capital do? Here in town, it's bonds. They don't do stocks here in town anymore, except for Lance is asking for people as well. But if you're going to interview on the Victory Capital side, on the fixed income side, this is the kind of stuff you have to know. And those guys know that stuff really, really well. They hired William 2 years ago. And William is like Mr. Bond. He was here. I don't know if y'all knew him, but Mr. Bond guy, he took John's class, but he was in the FSC looking up commercial mortgage-backed securities, corporates. He was just getting into it. And they hired him and they're like, this guy's great. He knew a lot more about bonds than a typical undergraduate student, but he was also a very kind of management science student as well. So I have students ask me, should I get my master's in finance? Well, if you're going to be a bond person, you don't want a master's in finance. You got plenty of finance undergraduate. You need to get a management science quantitative degree. Bonds is quant. Stocks is sectors. It's understanding businesses. It's that business breakdowns. It's understanding how does that business work? How does competition work? It's more strategy. It's more high level. Bonds is math and quant. So you want to get as much math skills as you possibly can. I think it's just cool stuff. I love bonds. I wish if I'd known now what I knew when I graduated from college, I would have become a bond person. I would have just called it Bill, forgot his name, Bill Gross. Call it Bill Gross and say, hey, I want to work for your firm. I don't know how famous he was in '86, so I might have gotten away with calling him in '86. But it would have been a great place to have a career. You can make as much money doing bonds as you can doing stocks. And it's an interesting field. Horrible place this year, right? The bond people are losing a lot of money this year because interest rates are up so much, but it's still a great, great, great career. So I'm hoping I'm either whetting your appetite or convincing you this is not going to be your career. I remember seeing a class it's like, man, there's so much I got to learn. That's kind of the right attitude. If you feel really, really stupid, that's the right attitude, because that means that's a field where it's complicated. There's a lot to learn. That's what they pay you for. If you're like, I want to do that career because I think I already got it figured out, that's not a good career. If you've already got it figured out, they're not going to pay you much to do that. All right, so fixed income. I mean, y'all feel overwhelmed with fixed income? Doesn't it seem like, my word, there's just so much there. If you feel like that, boy, that could be your career, because sitting there 50 hours a week doing nothing but this in 3 years, you're going to know a whole lot. It's, to me, really, really exciting. You just got to figure out what that area is going to be. All right. Get back in. All right. So we did all of that. We talked about if the coupon equals the yield, the bond's going to trade at par. If the coupon's greater than the yield, then you're getting a premium, because that's a really good bond. That's what we just saw with the bond we just did. That was worth $1,200. The coupon's less, then that's a discount bond. Now, when I was at USA, the bond people, they avoided premium bonds. And I wasn't sure what their theory was on that. Now, if you buy a bond that's a premium bond, it's going to fall in price. Because you buy it for $1,200, when it matures, it's going to be worth $1,000. So that sounds pretty bad, right? You buy it for $1,200, you know you're going to lose $200. But why are you willing to pay the $1,200? Because you're getting that 10% coupon, right? So you can get a lot more income. But for some reason, they avoided premium bonds. I'm not sure their logic on that. They're tax-wise, it's interesting tax-wise. I can't remember what the tax code said. I think the tax code somewhat adjusts for all of this, but if you buy a bond for $1,200, and that's going to reduce, kind of your yield, because you're paying a lot more for it. You're talking about ordinary income versus capital gains. There could be some play in that area. That may be one of the reasons they like discount bonds, because that a lot of your return is the price appreciation, which is a lower tax rate. So there could be something there, but I can't remember their logic. And in this formula, I don't know many undergraduate students. I mean, all undergraduate students know the first part, minus duration times the change in yield. How many of you know the second part? I'm not sure. They'd probably be impressed if you could use that in an interview. Probably most people are interviewing have to look at that formula anyway, because it's not one you just know off the top of your head. mainly we don't know it off the top of our head because we don't know convexity, because you have to go calculate it somewhere. But so you can't use duration. If it's a 5-year bond, you can guess on duration. It's a 5-year bond trying to guess on convexity. That's a lot tougher. All right, so here's the spreads from some years ago. Here's the spreads as of September. So AAA, that's the highest quality. The average spread is 30. Now, I'll put this not in basis points. I put it in percent. So 0.3%. So 30 basis points. So AAA 30 basis points. That doesn't sound like much. But do you remember what the default rate was on AAA? Okay, over 10 years? Less than 1%. So 1% divided by 10 is 10 basis points. You're getting paid 30. What was it just a couple of years ago? It's down to 12. You're just barely getting paid enough to cover it. And then in 2008, 157 basis points. Look at that. That's higher almost than what triple B. I mean, it's almost equal to a triple B. So in 2008, you could buy triple A rated bonds at the same spread, almost the same spread as you can get. Well, actually, look at triple B today, 147. So in 2008, you could buy bonds with a higher spread with triple A than you can buy triple B today. The current is 27. So we're about on average, which seems really weird to me. I was talking about this in Investment Society. We've got Putin. We've got, well, I guess the Middle East was pre-September, but you're worried about the Fed, you're worried about a recession, all this kind of stuff. You would think spreads would be wider today, don't you, than average? Doesn't this feel a little riskier than normal? The VIX, the volatility index is higher than normal, and yet we're slightly lower than normal. Double A, the average is 83. Their long-term is also about 1%, but you're getting paid a whole lot more on double A. Today, it's only 50 basis points, not much. Single A, 121, triple B, 178. If you remember the long-term on that one, for triple B, it's about 5%. So you need about 50 basis points, 5% divided by 10, you need about 50, and you're getting paid 150. You're getting compensated well. We talk about this in my risk management class. There's 2 risks you got to worry about with these corporate bonds: default risk and spread risk. So just because it doesn't default, if it's downgraded or spreads gap out, you lose money just because spreads do. So you have those 2 things. So it's price risk and then credit risk. High yield don't make sense to me at all today. The average is about 500 basis points. If you look at high yield, you need 240 basis points, but still, high yield, if we go into a recession, high yield is going to tank. And people are talking about a recession. I know the numbers today, that's probably why the numbers are so strong, because the economy's employment reports have been pretty strong. But 400 basis points, that's not enough for me. So can y'all see why I was buying high yield in 2008? 1,800 basis points. So just the spread was higher than what you expect on a stock. All they had to do was just survive. You're going to make a huge, you just survive a few years, you're going to make a huge, huge return. The strange thing in 08 is Matt was running our high yield bond fund. He was finding triple B bonds that were yielding 15, 16, 17%. And they were safe bonds. And he wanted to buy those because some of the high yield were pretty risky and he couldn't buy them because this mutual fund was called High Yield Bond Fund. And you can't buy triple B if you have a high yield bond fund. So we spent several $100,000 and they changed the name of the fund from High Yield Bond Fund to High Income Bond Fund, just so you could buy those. So once you put the word high yield on your mutual fund, the SEC comes in and says, no, you can't have more than 10% that aren't high yield. He's like, I got bonds that are safer and higher yielding. It's better for my customer, but I can't do it because of regulations. So we had to change the name of the fund. So this is what I say, you need to have some historical perspective. So if any of y'all want this spreadsheet, I can email it to you. It's tied to Bloomberg. So you just go into Bloomberg and automatically updates all these numbers. there's some strange thing going on between double A and single A that I haven't quite figured out what's going on, but it's like Bloomberg has them split, but I fixed it on here. But 2021 was, the bond market was saying nothing to worry about here. Stock market was pretty strong, especially growth stocks. And then 2022 happened and kind of messed all that up. And then 2023 came back and growth stocks came back. Spreads have essentially gapped out, but not all that dramatically. Well, I guess single A has gapped out quite a bit, but and it's bond market is telling you something. And bond investors are really smart people. And they're really smart people because if they get it wrong, they have all the downside and they have very little upside. So they're very worried people, but they're not worried today, and they should be worried today. So I don't get it. We need to get them to all come talk to us and tell us why they're not worried today. Don't you think they should be worried? Doesn't it feel like a pretty unusual period of time? And they're, for some reason, are not worried. I tried my hardest to find an updated of this, and Moody's and S&P both. So Moody's tricks you. They say you have to register. So I registered. It's great. Now I'm in. And then I click on the transition matrix and say, oh, this report requires another level. You know, spend $12,000 a year and we'll give it to you. I'm not going to do this. So they used to put those reports out there for free, and they don't anymore. I'm going to try to find an old one that I can show you because it is a really interesting read. It's really quite valuable. And you can find these numbers and see that the other thing to do is a transition matrix. So this is not a transition matrix. This is a default rate. Remember, this is only defaults. So these numbers overstate the risk because you also have recoveries. And on AAA, you can get as much as 50% of your money back. So even AAA paying 12 basis points, this implies you need 7.8 basis points, but that's before recoveries. You may only need 3 or 4. So that 12 still sounds kind of decent. The transition matrix is a bond that is rated AAA today. What percentage of them are still AAA 10 years from now? What percentage that are double today are still double 10 years from now? And that matrix is pretty interesting as well. And it changes over time. What's interesting is the report is, comparing a year like 2008 and 2009 to a year like 2010, looking which industries are going under. Like in 2020, a lot of energy companies are crashing because oil prices were so low. And then in 2022, you had a lot of companies that were crashing, Bed Bath and Beyond. Gosh, who else? There's a few big retailers that were really struggling. Why? Because their costs were going up. They couldn't pass that on, and they were going under. So it's interesting. It's not just how many firms defaulted, which industries are they in? That's what you're looking for as well. That's those event types of risk. So these are great studies. They give you a tremendous amount of information that just make you really smart in an interview. So if I were interviewing at Victory Capital, I would beg the professor to find at least an old, I do have some old Moody's reports, and at least read through that because it looks like it's hundreds of pages, but 90% of it's just charts and graphs kind of stuff. And just see what is the people who are doing this for a business, and that's their job. What are they worried about? What are they thinking about? Obviously, Moody's and S&P's customers are the most sophisticated people out there. Moody's and S&P are going to give them what they need. And so they're going to do that type of research. It's really fascinating stuff. It'll make you much, much stronger in the interview by doing this kind of stuff. And most undergraduate students don't do this. Get outside the textbook. I don't think textbooks even cover, I've never seen a textbook actually cover this. I'm sure John's class is going to talk about this. How many of you are taking John's class in here? It's a couple of you. It's a scary class, right? And you got to take scary classes. That's why you go on ratemyprofessor.com, and every professor to say, I hate this professor, he's too hard, she's too hard, that's the one you take, right? Because you got to push yourself. Finance is paid for complexity. So definitely want to know a general sense of the probability of defaults. Understand this history right here. I would almost put this in my wallet and carry it around with me just to know what those typical are. I doubt many undergraduate students know what the typical spread on these are. Now, what kind of spread is this? I guess I could have told you. You'll see it up there. It's option adjusted spread, right? So if any of these bonds are callable, it's not going to be the actual spread. It's going to be adjusted for that. So OAS. Why OAS? Because that's what you care about. If you're a bond investor, is OAS, not the total spread. All right. Questions on any of that? You're either real excited and bonds the place to be, or you're so overwhelmed. You're like, okay, let's get the stocks. They're a lot easier. Stocks are a lot easier. No question. That's why when Stuart retired and they say, who's going to replace Stuart? And some of my staff said, hey, Ron, you can take Stuart's place. The whole room cracked up laughing. They know how much I hate stocks. And sure enough, a few weeks later, I had his job. I was kind of interested to see. So I find bonds far more interesting, far more exciting, but equities are equities. So let's talk equities or stocks, really stocks. I don't like the term equities because real estate is equities as well. So stocks, we're kind of a little ahead. So we can spend a little more time on the team exercises. How did y'all do today on the team question? How many are sure you got it 100%? That's what matters. All right, so we'll see if it's a disaster. We'll redo it. So we have a little more time for a little extra practice. I would come to these team questions prepared because it's great practice for the exam. Plus, you need to know it anyway. So you just got to learn this stuff. I know there's some students like, I don't want to know anything when I graduate. I want to learn it all on the job, as if everything we teach in college is a waste, and it's just not true. There's nothing I'm teaching you here that you don't need to know in a job. And you're like, well, you've been retired for a decade. But yeah, I still interact with my peers in finance. I am constantly asking them. That's how I heard about spread duration. I'm constantly asking, what are you doing now that you were doing 5 years ago? What are you doing with AI right now? What are you doing Python? Are you still using Excel? What are you doing Bloomberg? Are you using Capital IQ? Those are the kind of questions I'm asking. So I'm not as dinosaur as you might think I am. All right. So when we're doing a stock, I'm using the Mordoran's. I like this page. He used them in his class. When you're doing a stock, stocks are a lot more difficult than bonds. Because bonds, you have a contract that tells you exactly what the cash flow is. All you got to worry about is if it defaults or not. If it doesn't default, you know exactly what you're going to get. Stocks, there's no contract. They can pay your dividend or not pay your dividend. They can go out of business or they can get taken over. There's all these kind of things that can happen. And so what the Mordoran says is start off with what's the value of the business as is. What is the value of Walmart if they never build another store? They don't do any home delivery. They don't do anything. They just stick with what they're doing today. What's the value of that? All right. What's the value of new things Walmart's going to do? New stores, going overseas. Walmart is doing some amazing stuff today with their website. So Walmart's trying to beat Amazon in the game of locations. So Amazon can get you stuff same day, but they can't get you stuff in 10 minutes. Walmart, you can order it and go pick it up in 10 minutes. I've done that with Home Depot. It's a little bit frustrating, Home Depot, because everybody's like, oh, wait, where is it? They're a little bit unorganized. And I haven't tried Walmart yet. Any of y'all done Walmart? Order and pick it up? Any of y'all done that? Is it pretty efficient?
Yeah.
I mean, it's sitting there waiting for you.
You go and park and they take it to your car.
They get your like in five seconds or 5 minutes or
They schedule like coming 10 minutes.
10 minutes. Yeah, it's pretty long. So that's my question, because that's not simple, right? If you're a Walmart, that's a whole new process. You've got minimum wage employees, smart, gung-ho people, but that's a whole new process. So, you know, anytime you do stuff like that, it's like, can they actually get it to work? They'll probably test it in a few stores, but that's something new for Walmart that might help them compete, because Amazon doesn't have nearly enough Whole Food stores to do that. What is Amazon doing? They're building more warehouses. So I'm amazed with Amazon. When I order something, I get it the same day. I still think that's pretty crazy. The first time that happened, I was like, wait, there's a typo. It says it's going to be here at 5 o'clock and it's only 2 o'clock. I don't get that. Same day. Pretty crazy. So what is that new growth? Where is it coming from? So Eli Lilly, what would Eli Lilly be talking about? What are they doing that's making their stocks so high? I was going to talk about it last night in Investment Society, but we ran out of it. What's the major drug Eli Lilly's doing that everybody's talking about? What? I heard something. The weight loss drug, have you ever heard of that?
Oh,
The multi-billion. It's an expensive drug, And what happens when a person stops taking it? You think of a pharmacy, weight loss, it works effectively. It's $1,300 a month. And if you stop taking it, it stops working. Can you think of a better product for a pharmacy than that? That sounds like nirvana, huh? I can't remember the name of the drug. I get the two companies mixed up. But I mean, that's a big issue. The question they're going to have to find is, what are the side effects? And the side effects are pretty horrible. And does the fact that someone takes that drug and loses weight, is that really going to change diabetes and heart disease? If people lose weight without exercise, does that really help the heart? Right? We got a crisis in this country of the food industry is killing us, right? All this corn syrup, everything. There's just food everywhere. So can we fix that? And I don't know, there's an article I saw where restaurant stocks are actually falling because of this drug. So I don't know how it works, but supposedly people are going to be driving by McDonald's much more easily than they have in the past. And that's pretty amazing, right? You have restaurant stocks falling because of this new pharmacy. Has that ever happened before? A pharmaceutical drug has caused restaurant drugs. So, and it's a challenge. So for Eli Lilly, their stock price is up dramatically. If that doesn't work out, that stock's going to fall dramatically. So you would have to value that one drug. And that's the amazing thing about a pharmacy. Pharmacies have what they call optionality. They have one drug, and if it works, it can be billions of dollars. Same thing with media companies. Disney comes up with the next Toy Story, it's massive, the next Star Wars or whatever. So they have these things where one success can be company. You can't do that with Walmart, right? What's Walmart going to do? This can be earth-shatteringly, picking up stuff at the curb is not an earth-shattering change. But a drug that people take and they suddenly start losing weight, that's a pretty earth-shattering drug. So that's the next thing, the value of growth. So the existing business, value growth, and then at some point, that value growth stops. At some point, all 10 billion people on the earth are taking Lilly's drug. We're all out there fit, running around, doing marathons, whatever. Once 10 billion people are taking the drug, how much more growth does Eli Lilly have? So that's when you have the steady state. The steady state's not the same as existing assets. The steady state is existing assets plus all that growth, all that comes together and gets steady in the end. Okay. Is Apple getting to that point where Apple's almost a $3 trillion company? It's hard for a $3 trillion company to make that value growth material. Because it used to be that value growth was against a $50 billion company. Now it's against it's hard to come up with, what is Apple going to do? It's going to be earth-shattering. So right now they're focused on fitness, right? The Apple Watch and fitness, that's good. But how much further can they take that? And can Apple come up with something radically new? So they did the laptop, and they did the iPhone, and then the watch. What's next? Is it going to be alternative reality or something such? Yeah, I don't know if people are if that's going to work out or not. That kind of, a few years ago, I was pretty excited about that, but it seems like it's more of kind of a curiosity than they're trying to get it into businesses so it becomes part of the normal operation of a business. So people are actually being trained, who knows? Sometimes like AI, it gets real exciting and nothing happens. And then suddenly in 2023, everybody's like talking about it and NVIDIA stock goes up dramatically. So, it's kind of tough. So that's essentially what we're going to try to value of the firm: existing state, new growth, and then at some point the new growth just becomes normal and there's nothing new and you just value it. So essentially this steady state is the existing business, but 20 years from now. Wants to get everything new into that. So that's what we're going to do. How do we value each of those pieces? And then the last thing is, what discount rate do you use? What's the risk of those cash flows? And we'll talk about that in terms of beta. So with stocks, that's really what you're after. It's all about growth. Current growth, new growth, and then future growth and steady state. We got to get those three numbers together. All right. So that's what we do with stocks. I did add Google to have you already picked your firms for the paper? They're going to do it this weekend. So I'll probably add Meta. I may add a few others. Meta was off a bunch. So I'll quickly add a few others. If you want to add one yourself, use software and video how to do it. So it wouldn't hurt you to go on Bloomberg and teach yourself how to do it. But I may add a few other companies. So, all right, we'll stop there.